Hi friends, Namaste. I am Chandrakanth. Welcome to Mr. Chandrakanth YouTube channel. In this video, we will learn about what is journal entry. So how to post journal entries with examples. So please watch until last minute. You will get some knowledge. So first of all, what is journal entry? So journal entries are records of a financial transactions, inflow of a transactions and outflow of a transactions. Okay, journal entries or records of a financial transactions flowing into the business and flowing out to the business. So inflow and outflow of business transactions will record in journal entries. So these transactions all get recorded in company books. Okay, all the transactions will record in company books. This is called journal entries. Okay, this is called journal entries. Creating a journal entry is a process of recording and tracking any transaction that your business conducts. So creating a journal entry. Suppose if you create any journal entry, it should be a process of recording and tracking of any business transactions. So this journal entry help transform business transactions into a useful data. So whatever we prepare the business transactions into journal entries, those journal entries will convert into useful data. And money that flow into an account or into an business. Money flow into an business that comes under debit side. Money flow out of a business that comes under credit. Money comes into business debit, money goes out from business, that is called credit. So here we will discuss some type of account, debit and credit. Here assets. Assets are the resources of business. This include cash, account receivables, equipments. Cash, account receivable, equipments are assets of a business. These assets increase the value of an asset that comes under debit, decrease the value of an asset that comes under credit. So expenses. Expenses are the cost of consumed assets, includes rent, interest expenses, salaries payable, wages. So these are the expenditures of a business. So these expenditures will increase means it comes under debit. These expenditures will decrease, that comes under credit. So third one is owner's equity. So the owner's equity represents the owner's investment of a business. So owner's equity represents owner's investment of a company. So owner's investment will decrease, it comes under debit. The owner's investment increase, it comes under credit. So liabilities. So liabilities are claims against assets. So these include accounts payable, wages payable, notes payable. Okay, these are the accounts payables, or these are the payables comes under liability. Suppose these liabilities decrease means it comes under debit. These liabilities increase means it comes under credit. And fifth one, revenue. Revenue is a cash received from business activities such as sales, dividends, services. Okay, based on these services, sales, dividend, revenue will generate. So those revenues will decrease, it comes under debit. Those revenues will increase, it comes under credit. Okay, we will see some of the most common journal entries for small businesses. So we will see some journal entries with examples. So the first one is on February 4th, 2019, I purchased material worth $50,000. Okay, on February 4, 2019, I purchased means owner purchased material worth $50,000. So this is called transaction. In this transaction, we will find two elements. That one is debit and another one is credit. We will find on this transaction two elements. So two elements we need to find on this transaction. One is debit, another one is credit. So here purchase material. Here we purchased material worth $50,000. So the $50,000 worth purchase of material will comes into business. So the asset comes into business, that is called debit. The asset value will increase. Okay. The inventory value will increase. Material means that is the inventory. So the inventory value increase means that comes under debit. So now the cash. So we purchase the material means we need to pay the cash. So we need to pay the cash, then we need to purchase the goods. So we purchase goods, we need to pay the cash. So the cash will go out. So asset will come and the cash will go out. So the purchase account data to cash account. The transaction is purchase account data to cash account. The narration is being the goods purchased worth $50,000. The transaction is purchase account data to cash account. And second transaction is on February 10, 2019, sold pens worth 50,000. So on February 10, 2019, sold pens worth $80,000. So the second transaction is February 10, 2019, sold pens worth $80,000. Here two elements is, one is sold pens. So one is sales, another one is cash. So okay, we sold the pens. The pens will go out by way of sales. So sold of pens means the pens will go out, and instead of that cash will comes in. We sold and cash received. So here cash receipt means, so the asset value increase. So the asset value increase means it comes under debit. So the sold goods means, so we sold goods means it goes out means, so the asset value will decrease. So the asset value decrease means, so it comes under credit. So one is cash receipt, another one is pens, in sold pens. So cash account data to sales account. So in the narration being the sold goods worth rupees $80,000. And the third transaction is on February 28, 2019, incurred expenditures worth rupees $5,000. Okay, the third transaction is on February 28, 2019, incurred expenses worth $5,000. So we incurred some expenditures worth rupees $5,000. So those expenses are stationary expenses, okay, office expenses, whatever it may be. So those expenses incurred, okay, so we need to pay the cash. So we need to pay the cash. The cash will go out. So the cash will go out means it comes under credit. So in this transaction, entry is expenditure account data to cash account. Whatever the expenditure incurred, that comes under debit, and the what is goes out means here cash will goes out. So the cash is credit. Expenditure account data to cash account. The narration is being the expenses worth 5,000 incurred. And fourth transaction is on February 28, 2019, purchased furniture worth $7,000. Okay, so fourth transaction is purchased furniture worth $7,000. Here we purchase furniture. Furniture is asset. So we purchase asset. Okay, this asset will comes into business. So we purchased furniture means we pay the cash. Okay, we purchased furniture, it will comes into business. So we need to pay some cash. It will goes out. So the cash bill goes out, comes under credit side. So the entry is purchases, means furniture purchases. Furniture purchase account data to cash account. Cash bill goes out means cash account will credit. Furniture account data to cash account. So the narration is being the furniture purchased worth rupees $7,000. Okay, this is called simple common journal entries for small businesses. Okay, I hope this video will useful for you. I hope you understand the transactions. Thank you, friends.